So, what if I told you there's a trading strategy that just doesn't care if the market goes up, down, or completely sideways? Seriously, it's a professional-grade technique that isn't about predicting the future. Instead, it's all about the statistical relationship between two stocks. Today, we are pulling back the curtain on pairs trading. This is the quant's secret for finding opportunity when two very similar stocks, for a brief moment, stop moving together.
Here's our game plan for this deep dive. First, we're going to tackle the big problem that trips up, well, almost every trader. Then, we'll get into the statistical magic that makes this whole thing possible. After that, we're going to open up the quant's toolkit piece by piece. We'll build a trade from scratch, we'll face the hard truths about what can go wrong, and finally, we'll wrap up with how you can gain a true market-neutral edge.
All right, let's kick things off with Section 1, the directional dilemma. This is the big one. It's that constant, nagging challenge of trying to guess which way the market is going to go next. I mean, let's be real for a second. When you strip everything else away, what are your odds of being right on a single directional bet? It's pretty much a coin flip, right? 50-50. It goes up or it goes down. And trying to build a career or even just consistent profits on what is essentially a guess, well, that's a recipe for a whole lot of stress.
You know, the legendary investor Peter Lynch absolutely nailed it with this one. As soon as our strategy depends on being right about the future, emotion barges right in. Our gut takes over. We get that anxious feeling to sell when things look bad, or we get FOMO and pile in at the top. Our stomach starts calling the shots, and that leads to anxiety and just totally unpredictable results. But what if we could just take that entire emotional coin flip right off the table?
Okay, this right here is the pivot. This is where we stop guessing and start using stats to our advantage. We are going to completely shift our focus. So instead of trading a direction, we are going to learn how to trade a relationship. And the secret ingredient, the concept that makes this whole thing work, is something called mean reversion. So what is mean reversion? Put really simply, it's just the idea that things tend to go back to normal. You know, prices can get stretched way too high or way too low. But over time, there are these powerful forces that tend to drag them back toward their historical average. It's like a rubber band. You can stretch it, but you can only stretch it so far before it snaps right back.
Now, the absolute best way to picture this in your head is the classic analogy, two dogs on a leash. Imagine you're walking two dogs. They're going to run around, right? One might dart ahead for a second, the other one might fall behind to sniff something, but they can never get too far apart from each other. Why? Because they're connected by that leash. That leash is the historical relationship, that strong correlation, and no matter what, it always eventually pulls them back together. In pairs trading, we're not betting on the dogs, we are betting on the leash.
And hey, don't just take my word for it. This isn't some obscure theory. This quote gets at the fact that this exact principle has been a core strategy for some of the most legendary hedge funds ever, like Renaissance Technologies' Medallion Fund. They trade the relationship between things that should be linked, like crude oil and gasoline, and they just wait for that gap to get too wide before betting that it's going to snap back to normal.
So, what does this actually look like with stocks? Okay, take two absolute giants in the energy world, Exxon and Chevron. Trying to predict where Exxon's stock will be next month? Good luck. But what we do know is that both of these companies are driven by the exact same things: the price of oil, global energy demand, big geopolitical events. If you put their charts on top of each other, they move almost in perfect sync. They are two dogs on the very same leash, and that relationship is way more predictable than their individual price moves.
Okay, theory is great, but how do we actually do this? It's time to open up the quant's toolkit and see exactly how we turn this idea of mean reversion into a systematic, rules-based trading plan.
The process is actually beautifully logical. It breaks down into four really clear steps. First, we've got to find our two dogs, a pair of stocks that are super correlated. Then, we need a way to measure the leash between them, and we do that with something called a price ratio. Next, we have to figure out what normal looks like by finding the average of that ratio. And finally, we set our entry bands, the exact points where we say, okay, the leash is stretched way too far.
The first tool in our kit is the price ratio. This is our main metric, and don't worry, it sounds way fancier than it is. We literally just take the price of stock A and divide it by the price of stock B. That's it. This gives us one single number that perfectly represents the relationship between them. This ratio is what we watch, not the individual prices. It's how we measure the exact distance between our two dogs.
Okay, so we have our ratio, but how do we know when it's moved too far from normal? For that, we use a classic statistical tool called standard deviation. And please, don't let the name intimidate you. All it does is measure how much something typically wobbles around its average. It's the tool that lets us put a number on what a normal wiggle is, so we can then spot when a move becomes statistically extreme.
And this brings us to a really crucial number, 95%. This is a bedrock rule in statistics. For most data, about 95% of all the action is going to happen within 2 standard deviations of the average. So what does that mean for us? It means we can be pretty darn confident that the relationship between our two stocks is going to stay inside this statistical channel almost all of the time. This is our zone of predictability.
And here is the big twist. This is the secret sauce. We aren't betting with the 95%. We're doing the opposite. We are patiently waiting for that rare 5% of the time when the relationship stretches beyond that boundary. Our entire strategy is built on spotting these extreme, low-probability moments and then betting that the 95% rule is going to kick back in and pull the ratio back home. We are trading the exception, not the rule. Okay, now for the fun part. What's really cool is how we can see all of this on a chart. So let's walk through the anatomy of an actual pairs trade step by step so you can see exactly how these tools create a crystal clear trade signal. So step 1, we take our price ratio. Let's stick with our chevron divided by Exxon example, and we plot it as a single line over time. Remember, this line isn't price. It's the relationship between the two stocks. Next up, we calculate the average of this ratio over a good chunk of time, like the last year. Then, we just draw that as a flat, horizontal line right across the middle of our chart. This line is normal. It's the center of gravity that the relationship tends to dance around.
Now we add our action zones. We calculate the standard deviation, and we draw 2 more lines, one at 2 standard deviations above the average and one at 2 standard deviations below it. And just like that, we've created a channel that should, based on our rule, contain about 95% of all the action.
And now we wait. We just watch our ratio line move up and down inside the channel. Most of the time, we do nothing. But our signal, our moment to act, is when that line breaks outside of that 95% zone. And boom! Right there on the chart, you can see it. The ratio is spiked up and crossed above the top band. The leash is stretched to its absolute limit. That is our signal.
So here's the beautiful logic. When that ratio is stretched way up high, it means stock A is historically overpriced relative to stock B. So our trade is dead simple. We short the overperformer, stock A, and at the exact same time, we go long the underperformer, stock B. Instantly, we've created a market-neutral position. We don't care if the whole oil sector goes up or down tomorrow. We just need that gap to close, for that leash to pull them back together to make a profit.
Now, so far, this sounds almost perfect, doesn't it? But no strategy is risk-free. And for pairs trading, the risk is simple and it is severe. We have to talk about the brutal truth of correlation, because ignoring this part is how people blow up their accounts.
Think about it. The entire foundation of this trade, everything we've built, rests on the belief that the leash connecting our two dogs is unbreakable. But what if it isn't? What happens if something fundamental changes and permanently alters their relationship? This is the #1 risk in pairs trading. So what kind of thing can actually snap that leash? Well, think about major earth-shaking company news. A company fires its CEO and the stock rockets up on hopes of a turnaround. One of your companies gets a surprise merger offer, and its price totally detaches from the industry. Or a devastating short seller report, like from Hindenburg Research, comes out and accuses a company of fraud. These are not just statistical wobbles. These are fundamental shocks that can break the relationship for good. And this is the most critical warning I can give you. When a relationship breaks for a fundamental reason, just sitting there and waiting for it to revert to the mean is a losing game. That gap can just keep getting wider and wider and wider, and your losses will mount. The brutal truth is that a divergence can last much longer than your margin account can stay solvent. This is why risk management isn't just a good idea. It is absolutely paramount. Okay, so we've looked the risks right in the eye. Now let's bring it all back home and summarize the really powerful edge that this market-neutral way of thinking can give you as a systematic trader.
When you put these two approaches right next to each other, the difference is just night and day. On one hand, you have the high-stress game of trying to predict the future. It's a coin flip. On the other, you have the quiet confidence of trading a high-probability statistical pattern. One is totally dependent on which way the market winds are blowing. The other is designed to be neutral to them. You're shifting from anxious guesswork to calm, systematic execution.
So let's wrap this all up with your takeaway checklist, your rules of the road. First, do your homework and find pairs that are truly deeply connected. Second, always use statistics, not your stomach. Third, structure your trades so you stand to make at least twice what you're risking. Fourth, and this is non-negotiable, always have an exit plan, a stop loss for when you are wrong. And finally, never ever ignore a fundamental change. If the leash breaks, you get out. Period.
And I'll leave you with this one thought to chew on. We've just explored one specific kind of relationship, two stocks in the same industry. But this way of thinking, it opens up a whole new universe of possibilities. So if you could trade a relationship instead of a direction, what other hidden patterns, what other statistical connections do you think are just waiting to be discovered out there in the market?